Good morning. As we head into the weekend, the U.S. markets are, of course, closed. But the story that has Wall Street completely electrified is what happened in the final trading session of the week with Liberty Energy, ticker LBRT. At the closing bell on Friday, October 17, 2025, the stock finished the day at $15.32. That was a move of positive $3.38, an absolutely explosive single-day gain of 28.31%. Now, when you see a 28% move on a billion-dollar company, the immediate expectation is that they must have reported a massive blowout earnings beat, crushed all expectations, and guided to the moon. The reality, however, is almost the exact opposite. This 28% surge, which undoubtedly vaporized short sellers, was built on a quarterly report that, on the surface, looked terrible. This is one of the most fascinating expectation versus reality disconnects we have seen in the energy sector this year, a sector that many had left for dead. The common belief, the narrative that has been building for months, was that the oilfield services sector, and Liberty in particular, was heading for a rough patch. Macro forecasts from groups like the EIA have been pointing to a global oil oversupply peaking in 2026, which would put significant downward pressure on prices. Analysts were cautious, with most ratings on Liberty sitting at a hold and price targets hovering right around this $15 mark, not 28% below it. The company itself, in its last quarterly update, guided for a softening in revenue and activity. So everyone was braced for a weak Q3 report that would confirm this bearish thesis. And then the report hit. The numbers were frankly not good. Liberty announced Q3 revenue of $947 million. That wasn't a beat. That was a 17% decrease from the same quarter last year and a 9% decrease from the prior quarter. Adjusted EBITDA, a key metric for operational health, came in at $128 million. That is a staggering 48% collapse from the $248 million they reported in the third quarter of 2024. Worse yet, the company posted an adjusted net loss of 6 cents per share. So let's be perfectly clear. Revenue down 17%, adjusted profits down 48%, and the stock rallies 28%? This is the kind of event that makes retail investors using a simple Robinhood app scratch their heads, while institutional traders on Interactive Brokers platform terminals were likely piling in. The expectation of a weak report was met, but the reality of the market's reaction completely shattered that thesis. So what on earth happened? The market wasn't trading the past. It wasn't even trading the present. It was aggressively and violently repricing the future based on two very specific and one might say hidden details. First, the reason the company was able to report any net income at all, which came in at $43 million, was because of a non-cash item, a $68.4 million net gain on investments. This wasn't operational excellence. It was a paper gain on their equity stakes in other companies, like their holdings in the nuclear tech company Oklo and the gas producer Tamboran. This gain effectively masked the deep operational slowdown. But the real driver, the narrative that lit the fuse, came from the CEO, Ron Gusek, on the earnings call Friday morning. He didn't just report the numbers, he fundamentally reframed the entire market. He looked at the slowdown that everyone was fearing and called it transitory. But he went a step further. He argued that this slowdown, this period of pricing pressure, is good for Liberty. Why? Because it is, quote, accelerating equipment attrition and fleet cannibalization across the industry. In plain English, this downturn is killing his weaker competitors. He is essentially telling the market to ignore 2025. He's saying that while the private, less capitalized frac companies go bankrupt, Liberty will weather the storm. And when the oil oversupply does peak in 2026 and producers need to start completing wells again, Liberty will be one of the few high-quality service providers left standing. That, he argued, will set the stage for a more constructive supply and demand balance and, most importantly, better pricing dynamics in the future. This is what the 28% spike was about. It was a massive, coordinated bet that the CEO is right. The market is looking through the trough of this slowdown and placing its chips on 2026 and beyond. This is not a trade for the faint of heart. This is a high-stakes bet on a cyclical industry, a far cry from the secular growth stories of Nvidia stock or Tesla stock. This is about timing the absolute bottom of a cycle, and the market decided in one single session that the bottom is in. The second part of this narrative shift was the company's tech and diversification angle. Gusak highlighted the launch of Forge, Liberty's own large language model for intelligent asset orchestration. While everyone is focused on Nvidia stock for AI, here is an oilfield services company deploying its own AI to optimize its frac fleets. Furthermore, they are aggressively expanding their power generation business, Liberty Power Innovations, with a goal of bringing over 1 gigawatt of capacity online by 2027. This changes the story. Liberty is no longer just a company with frac fleets. It's pitching itself as a tech-enabled, vertically integrated power and services provider. This is the kind of story that helps a stock's valuation multiple expand. The trading session itself on Friday was a technical marvel. The volume was absolutely immense, crushing its daily average. This move had all the hallmarks of a vicious short squeeze. Given the bearish consensus and the terrible headline numbers everyone expected, the stock was likely heavily shorted. When the market decided to buy the forward-looking story instead of selling the quarterly numbers, those short positions were instantly offside. They were forced to buy back shares at any price to cover their losses, and that forced buying creates a feedback loop, pouring gasoline on the fire and sending the stock parabolic. This is why self-investing requires so much more than just reading a headline. If you had just seen the revenue miss and shorted the stock, you would have been annihilated. This is where advanced online investment tools, perhaps those available on the Fidelity trading platform or through interactive broker stock trading, become essential for seeing the order flow and understanding why the move is happening in real time. Many investors might prefer the perceived safety of Fidelity mutual funds or Fidelity ETFs in the energy sector, but a single stock event like this demonstrates the massive volatility and opportunity in picking individual names. So let's ground ourselves in what Liberty actually does, because this context is vital. Liberty Energy is a pure-play North American energy services company. Their primary business is hydraulic fracturing, or fracking. When an E&P company like Occidental or Pioneer drills a horizontal well, they call a company like Liberty to come in and complete it. Liberty brings its massive high-tech frac fleets, which are essentially giant mobile pump trucks, and injects a mixture of water, sand, and chemicals at extremely high pressure to crack the shale rock and release the trapped oil and gas. Their revenue is directly tied to the capital expenditures of oil producers. When producers are drilling and completing wells, Liberty is busy and making good margins. When producers pull back, as they are doing now due to macroeconomic uncertainty, Liberty's fleets go idle and pricing comes under pressure. They compete directly with the giants like Halliburton and Schlumberger. This is a tough, cyclical, capital-intensive business. That's what makes this bet so interesting. The market isn't betting on the business as it is today. It's betting on the business it could be in 2 years, with fewer competitors and a new high-tech power division. This entire 28% move hinges on believing the CEO's look-through-the-trough story. So, I want to know what you think. Comment below. Is this transitory slowdown a real opportunity for Liberty, or is it the start of a much deeper cyclical downturn for the whole sector? Looking forward, the tension between expectation and reality is now set at a much higher level. The new expectation, set by Friday's price action, is that the 2026 recovery thesis is correct. The stock is now priced for a significant recovery. The reality will be determined by what happens over the next 12 months. The bull case is clear. The CEO is 100% correct. The current industry slowdown is sharp and painful, and it successfully bankrupted smaller private competitors who can't afford to stack their fleets. The oil glut peaks and fades by early 2026, just as LNG export demand ramps up. E&P companies, flush with cash, restart their completion programs, but this time they have to fight over a